asset portfolio in the coming weeks, where we're going to find out if that is the case with the Chief Executive, Colin Harrington. A warm welcome to you, Colin.
Thank you, Sarah. Nice to see you. I'm sorry I can't join in the pink powder room in person, but thanks to everybody out there for watching this tonight. We're really respectful and appreciative of your time, and just thanks for taking it and spending it with us this evening. I want to preface, after flipping through a few pages of disclosures here, I know for some of you this will be the first time you've heard our story, and we also have a really engaged set of shareholders that know it well. I'll try to not make it too boring or too complex for any of you. But tonight we want to talk about who we are, what we have right now in our portfolio, and where we're going. And before I begin any of that, I'd like to talk about our core values, and I'll tell you why. Because when we launched Zephyr, we launched it last year, and the very first thing we did was define our core values, our principal values, because they're fundamental enough that everything else I'm going to talk about tonight stems from these two things. They're very simple. It's to be responsible stewards of our investors' capital and to be responsible stewards of the environment. These things go hand in hand, but everything else that we do flows from these. They're the base and the core of every decision that we make. So Zephyr, it's an AIM-listed oil and gas company. We're 100% focused on responsible resource development and carbon-neutral operations in the Rocky Mountain basins of the U.S. You don't often hear responsible development and carbon neutral together in this industry, and I'll walk you through what we're doing there because I'm very excited about it. Our primary asset is a significant operated asset in the Paradox Basin of Utah. We have a 25,000 acre lease position, 3D across it, extensive log and core data that we've just received. We have a well that has been drilled recently for research purposes, but it's available for reuse as a low-cost, low environmental impact sidetrack host, and we're targeting drilling from that in July. We also, we think, have potential for multiple overlying reservoirs above the historically prolific King Creek Reservoir in this area. So that's our primary focus. We also have a very exciting high-margin strategy in non-operated assets. We look for low-risk, high-margin assets in well-established basins like the DJ or the Bakken. We focus on investments we can make where we have near-term drilling opportunities with very strong operators. We look for low acquisition costs, very rapid paybacks, and strong margins. We've been successful at putting a number of these together in the past few months, and we use the cash flow that gets generated from those to either drive back into our Paradox development or to generate additional acquisition opportunities and purchases. We are a self-sustaining platform for organic growth. We're well-funded, and we believe we have all the pieces in place to grow this company dramatically over the coming year. In terms of the corporate overview, yesterday we closed at a share price of 5.25p. That's a market cap of about 64 million pounds. We have zero debt outstanding, and I'm a strong believer in very, very conservative use of leverage, if any at all. So hence the clean balance sheet. Our board has purchased 12% of the company. We've put in $1.6 million of our own capital to date. And we also have an asset in historical tax losses from the predecessor company, which was Rose Petroleum. $16 million of tax losses, which can be used to shelter and offset future U.S.-driven income. I won't go too deep into our board. If anyone's interested, all the bios are available on our website. But just to point out here, we have a board that can grow with this company. Rick Grant has run one of the world's largest natural gas infrastructure companies. He's had multiple exits and lots of experience running multi-billion-dollar companies. We have three great non-execs, including Rick, that have all had extensive AIM experience as well as private equity-backed experience. They each bring a real wealth of talents and perspective to our board. In terms of the rest of the management team, Chris Eady has been continuity from Rose to Zephyr and has run an incredibly tight operational ship from a corporate perspective. And Gregor Maxwell is an absolute data-driven phenom. He's responsible for all of our subsurface work, leading our A&D activity. He used to be at Apache and Chevron. He's really done a great job in developing a data-driven strategy to develop our resources and help us acquire others. So as you see from the share price, the last year has been one of transformation for us. Some highlights from the last year were being awarded a $2 million non-dilutive U.S. government grant to drill a research well on our acreage. We call it a dual-use well because it both provided significant data for us in terms of cores and logs, but it also can be reused as a low-cost, low environmental impact host to drill for production, which is what we were targeting to do in the next month. We had a very successful operation drilling down and getting that data. This is in December and January. Very cold conditions, adhering to COVID protocols. We drilled to TD in record time in this basin. We've acquired 113 feet of continuous core, 31 sidewall cores, and a lot of log data across our position in the Northern Paradox, which previously hadn't had a whole lot of data pulled out of it. And we came up with an agreement to acquire the first in a series of non-op interests in the Williston Basin. So that was in 2020. It set the table very nicely for what we're doing in 2021. With our friends at Turner Pope, we had a highly successful capital raise, 10 million pounds in March, that has fully funded us for everything we want to do in this portfolio. $3.5 million of that amount is going to drill the horizontal appraisal well on our Paradox acreage. We used $300,000 to fund an acquisition of distressed non-op working interests in the Williston Basin. We have another $7.7 million in remaining CapEx that we're spending on those wells. And we've also just recently completed a small tuck-in acquisition that both has current wells being drilled and 22 more wells in the near future. What are we going to do the rest of this year? My real focus and our team's focus is expanding this opportunity set. We're expanding in all facets. We're expanding the corporate platform on the ESG front by doing what I feel is a real industry-leading effort to be 100% carbon neutral by this September. We're expanding our shareholder base by dual listing on the U.S. OTC market. We've had a lot of interest from investors in the U.S. side. I'm based in the U.S. All of our assets are based in the U.S. And we will always continue to be proactive in our outreach to shareholders and to existing partners and also new potential partners. From the Paradox Basin standpoint, we've got a huge amount of work underway and results that we'll talk about in the next few weeks around our geological analysis, both of the prolific Cane Creek, but also of overlying reservoirs, and also the potential for hydraulic stimulation of this acreage. We are deep in planning for a safe and effective drilling, horizontal drilling at our State 16-2 well, and we are harnessing the cash flow that we're making in the Williston, which will help us fund further development beyond just this initial well here. In terms of the non-operated assets, we now have 3 wells online and producing. 2 of those wells came on this week. These are unconventional wells with a lot of flush production where you get a huge amount of production in the first year. We feel like it's a great time at $72 a barrel to be getting that flush production online. We've got 2 more similar wells coming online in the next month. And then from our new small acquisition, we've got wells that are currently being drilled and much more to come in the next 18 months. We've got a deep pipeline of other acquisitions. We'll be very judicious in our use and in our pursuit of these, but they are things that we are considering. I want to just stop and take a moment on this pledge to be 100% carbon neutral by September, because for me, alongside of growing our volumes, this is the single most important thing we can do. We're collaborating with a phenomenal company called Prax. They're a British-based company with a footprint everywhere, including the U.S., in oil trading, refining, downstream operations, and a lot of work going into their thought around carbon neutrality. We are working with their team here to jointly measure and then mitigate 100% of our operational emissions. So this is everything from the drilling of a well to trucking to the refinery. We will mitigate those emissions through the purchase of verified emission reduction credits from reputable projects. And I think this is setting a new bar in terms of our industry. It's easier for us to do right now. We're a small company, but we are starting as we mean to go on. And as we grow, we are going to put a lot of time and effort into it. There's a cost to what we're doing. Mitigating our emissions are estimated to cost about $1 per barrel when we look at our production for the coming year. But on the flip side, there are real benefits as well. Going back to our core values, obviously, first and foremost, the biggest benefit is from an environmental standpoint and from helping set the bar for our industry here. But secondarily, we think those two core values go hand in hand, and there are economic benefits that come with this pledge as well. We can see access to an expanded shareholder base, particularly around ESG funds. There are $30 trillion of ESG funds existing out there right now. And if we can attract a small portion of that, I think it'll benefit all of us. Lower cost of capital on the debt side, premium pricing for our products. If we can offer carbon neutral barrels, we fully expect to see in the marketplace a higher commodity price for those barrels that we sell. And we think we'll have much better regulatory and community relations in the areas in which we work. Climate change is real. This is our perspective. We know it's real and that our industry has contributed to the threat that it poses. We think we can have a much stronger impact from within the industry rather than from divestment of the industry. Oil and gas is in global common usage, and while it is, our industry, in my view, has a strong role to play in reducing the emissions from it. We want to be at the forefront of that. We think good environmental focus means good business, and that's why we're spending so much time and effort on this. One last acknowledgement here before I turn to our assets. We've grown in a very short time from about a 2 million pound market cap company to something in north of 60. We couldn't have done that alone. We've had great partners, starting with Turner Pope, who has helped us with some very successful fundraisers over the last year. Couldn't be more thankful for their support and advice. The same thing goes with Allenby, our nomad. Jeremy Porter, Liz Kirchner, they've done just a remarkable job and a creative job in helping us adhere and navigate the AIM waters. And I'm very, very thankful on a daily basis for their advice. Others to note, we have partnered with the Energy and Geosciences Institute in Utah. It's a world-class research organization, and with the Department of Energy and their National Energy Technology Lab. Just huge resources from us. Beyond providing us with a government grant to drill our research well, we're working with them, again, day in, day out to help understand and make more efficient and exceptional the production that can come from the Paradox Basin. We're very, very thankful for their support. And to the team at Flagstaff and Memory Crystal for their just unrelenting efforts in helping us grow here. So onto our portfolio. Let's start with our non-operated assets. This is the cash flow engine which fuels everything else we do. Right now, our interests are in the Williston Basin. It's one of the most active and prolific basins in the U.S. A couple quick stats to look at here. You can see this yellow line. This is the rig count in the basin, which really falls off a cliff starting in the second quarter of last year with COVID and the commodity price turmoil. We have not seen a big uptick in those rigs yet. It's still running 20 rigs or below. It shows you the level of distress and a lack of capital that's still in this industry, and that poses a lot of opportunity for somebody like Zephyr when we are a buyer of assets in this market. On the right in the pie chart, I just wanted to point out that Continental, which is circled CLR, and Whiting, which is circled Whiting Petroleum, those are our two operated partners. They're two of the biggest players. Continental is the biggest player in this basin. We're very thankful to be able to benefit from their expertise. So in March, we acquired the Whiting wells. This was 5 wells. 3 are now on production and 2 are awaiting tie-in. They've been completed but not yet tied into the infrastructure. They're operated by Whiting, again, a very active operator. We were able to buy these from a private seller that hadn't met any of its historical or obviously its future capital obligations. So we were able to step in for a very minimal upfront purchase price, $350,000, which is less than $1 a barrel acquired, step into these obligations, which we have now funded to the operator, and it's meant revenue from almost day one and access to the flush production of these 4 wells that have just come online or are coming online right now. They're nice size working interests, and they're spread across 3 different drilling pads, so good diversification. We love the location of these, and as they come online, we'll be updating the market with guidance as to what the production profiles look like. We've also done a small tuck-in acquisition nearby. This is an acreage acquisition, which gives us working interest in a drilling and spacing unit. There are 2 wells being drilled there right now. We are participating in those. So that's net CapEx to us right now of $135,000, but up to another $710,000 as more wells get drilled on this acreage this year. We love deals like this, low upfront purchase price and optionality to participate in many wells in the future. Our strategy here remains the same. We will look to acquire other low-risk assets with near-term potential. We like wells that have been drilled or are being drilled in these core basins. We look for rapid paybacks. We want payback in under a year. We want a 2.0 or more money multiple and better than 40% IRRs. Those types of returns are still available in this market. We like the fact that this will help us utilize our tax shield and that we can step in alongside strong operators. We're very careful to layer CapEx and cash flows from this up against our development plans for the Paradox so that we can most effectively utilize our cash balances. Right now, this portfolio for the second half of the year, our guidance is 720 barrels a day average production for the next 6 months, but we will be updating that guidance once we see the volumes from these 4 duck wells that have just come online, and we'll be doing that in the third quarter. So on to our operated asset, and this is a picture of the drilling that we did in December. We're in the Paradox Basin. It's Utah. We have 25,000 acres. Zephyr and Rose Petroleum before that have been active here since 2014. We've got an application filed for a new federal unit over our acreage. Unlike most of the U.S. In the active basins here, this has historically been a natural fracture play, meaning it doesn't require hydraulic stimulation. The primary productive zone is the Cane Creek Reservoir, but there are multiple other targets, and we've got great seismic, which helps us look at those. The potential here, it's a natural fracture play, so wells that intersect the natural fractures can be very prolific, high rate, have substantial recoveries. But however, past drilling results have been mixed, about 50-50, and that's due to there was a poor understanding of the geology, there were older technologies being used, old seismic, and really, we've never seen hydraulic fracture being used in this area. So the reason why we are excited about this opportunity is we think we can improve on historical success rates of 50-50. The move from 2D to 3D and modern 3D seismic has been dramatic. The introduction of horizontal drilling, introduction of much better directional drilling techniques, none of that has really been deployed here. We have a chance to do that with our seismic, with our modern crews, and our extensive log and core data to make a real improvement on this. This reservoir, this basin has been prolific for a number of years, but you can really see the increase in production as the initial 2D and 3D seismic was put in place. 10 million barrels produced over the years, but that's been tailing off, and it's really been overlooked during the onshore fracking boom in other basins. We have 25,000 acres, as we said, seismic across the whole position, very good access to export roads and pads. And because the Biden administration has halted the issuance of new federal leases, an existing contiguous lease on relatively virgin territory is exceedingly difficult to replicate. We think there's great scarcity value in what we've put together. So let me give you a note of caution, a note of excitement, and then how we're approaching this as a whole. Note of caution is this is an appraisal project. It's in an underexplored area. It's a highly pressurized reservoir. The presence of natural fractures, which mean if you hit a natural fracture, you can see substantial pressures flowing. And unlike other resource plays that we see in the DJ or the Bakken, for example, there's very little vertical well coverage. So there's not as much historical data we can look at. If this area was easy, it would have definitely been exploited already. And we are continually having to work to keep our lease position and our overall footprint intact. And we've done a lot of that over the last 2 years. The reason we're excited about all of this is largely for the same things. It's a very large contiguous position. It's in an underexplored area, meaning we think there's a lot of upside. The highly pressurized reservoirs can result in very big wells that you drill. We see a lot of potential in the Cane Creek alone. That's the historically prolific reservoir. But we have also done a huge amount of work on the additional targets, and we're doing more so there. We see reserve expansion, not just through the overlying reservoirs, but also the potential to hydraulically stimulate this. That analysis is underway. And we have very good analogs just to the south of us at a field called the Cane Creek Field, and also at the 2811 vertical well, which is in our survey area. The way we've approached this is to mitigate as much risk as possible and maximize the risk reward. So we've spent the last 18 months de-risking where we can. We have de-risked the resources by acquiring modern 3D seismic, by acquiring 113 feet of continuous core, 31 sidewall cores, and a lot of log data. We've de-risked the drilling by, we've already drilled this well to 6,450 feet. That's where we'll be kicking off and starting the new. And we demonstrated through this recent drill that we can really improve drill times in this area. We've decreased our capital exposure by benefiting from $2 million in government grant that went to fund the top part of this well. So we think between our forecasted cash flow and advanced technical work that we've done, we're going to have multiple bites at the apple here, and that we're in a very good position from a risk-reward standpoint. Observations to date, log and core analysis suggests hydrocarbons across the Cane Creek and the bulk of the overlying reservoirs. We've got draft analysis that shows a very similar reservoir to the fields below us. Our matrix reservoir quality is better than we expected. We have compelling evidence of a stacked continuous oil and gas play that can be developed either by the natural fracture network or through hydraulic stimulation, and we'll release more on that at the end of this week. So very quickly, Sarah, because I know we're out of time here, our single well economics, NPVs, $10 million at $70 a barrel. You can see we're going in, the black line here is the well we drilled earlier this year. We're starting at 6,400 feet at the kickoff point and utilizing this existing well as a low-cost host for drilling out horizontally from that fold. And in terms of our 2C valuation overall, at $60 a barrel, NPV of the Cane Creek alone is $156 million, and NPV of the same Cane Creek alone at $70 a barrel is $225 million, with significant potential upside through the overlying reservoirs if they are viable. Our operations team is under contract. It's the same team that's drilled most of the wells in this basin, the Fidelity team, the same team that drilled our well before. We look to begin doing this in July. So in terms of next steps, we will be drilling the Paradox Basin. We feel like from a risk-reward perspective, it's very well placed, and we're seeing great cash flow from our Williston assets, high IRRs, rapid paybacks, and a lot of cash flow that can be redeployed back into our Paradox efforts or on more deals. And in the coming months, there'll be a lot that's happening. Our Paradox data evaluation is going to be released by the end of this month. We'll get our rig contracts and permits shortly. We'll be spudding the well in July. It's 20 days drilling operation, 45 days testing afterwards if successful. Our Whiting Ducks will all be online in July. We'll be updating guidance, refreshing our CPR, moving to carbon neutrality, and getting a U.S. OTC listing all in the third quarter of this year. My vision is for growth across the company this year. We can have growth from resource to reserve conversion with Cane Creek appraisal success. We can have resource addition through the overlying reservoir potential. We can have growth through development, which means either natural fracture or hydraulic fracture potential, and growth through smart acquisitions. All the while, we're going to stick to our core values and be responsible stewards of our capital and your capital, and responsible stewards of the environment. Sorry for running over shortly there, but we'd be delighted to take questions.
Thank you very much indeed, Colin. So, self-sustaining, no debt, a board that will grow with the company, a lot of skin in the game. You're going after those ESG funds, and you're chasing community and regulatory approval, although you haven't got mine because you overrun. But you are a responsible steward of investor capital. Let's go to the investors. Tom Henderson asks, Colin, really excited for the lateral well being drilled, but any indication when the core data will be fully analysed and released?
So we plan to release our analysis of everything to date by the end of this month, by June 30th. And that will encompass not just the overlying reservoirs, but also the work we've been doing with a third party to analyze the potential to hydraulically fracture both the Cane Creek and the overlying reservoirs as well. There'll be a lot of data that comes out at that point. That should be a nice kickoff to spudding shortly thereafter. It's really important for us to get that work done before we spud, because it'll help us understand a better development path both for this well and for future wells.
Okay, speaking about a nice kickoff, we've seen a nice uptick in the rise in oil prices. So John Sullivan asks, given the recent rise in oil prices, are you still seeing value in potential further additions in the States. And I think what you were saying to us is, yes, but it's really difficult to buy at the moment.
Yeah, I think it's a great time to be a buyer. This sector is still starved for capital. So the larger players are out there drilling and completing their wells. But at the smaller end of the market, whether it's money from Wall Street, money from high yield debt, or money from private equity, we're really not seeing a return of capital. And that's kind of evidenced by the rig count in the Bakken. You can see that there's a much more cautious reentry. And the people who have non-operated interests in the area that we're looking at often can't fund their exposure to the CapEx. They just haven't had enough time at this oil price yet. So we still see great opportunity. We're obviously highly selective. We're location driven. But if we find something in the right location at the right cost, absolutely we would look to acquire more.
And in terms of sort of capital, venture capital, you have applied to go on the OTC market. So what do you reckon, 6 weeks' time before you start on that market?
Yeah, I know that there's a lot of activity right now, a long queue, but that's what they're telling us is about 6 weeks to get that application approved and begin trading.
Okay, Liam Graham now. Hi, Colin. Very happy shareholder here. Now that we hope to be carbon neutral by September, have you had any discussions with any new institutional investors that would like to come on board, perhaps around the time that we achieve this?
Well, I can't speak for when investors will make decisions, but we certainly have had an incredible amount of outreach from that announcement. Financial institutions as well as investors and people that want to help participate and help us get there. So I'm really gratified by that. I think that it's absolutely the right move just as a citizen of the world, but it's also a really good move financially to help expand that investor base, and we certainly hope to see an impact from that as we move towards it.
Okay, Tim Adams asks, Colin, can you briefly explain how important the carbon neutral pledge is in regards to the company's attractiveness for new investors, as this is a very impressive target, which he thinks is being missed by the market?
It's an ambitious target, and we really hope that we are leading the charge. As far as I know, that we are. I think there's no question that you're going to see the industry move this way. When you see a tiny activist fund take board seats on ExxonMobil's board, that demonstrates which way we're moving here. There's going to be a lot of pressure. I'd like to be out in front of it and help. I'd love to see many more companies join us. There's a lot going on in the industry, from geothermal to solar. To me, this fits perfectly with what we know, and I can't wait to see other companies follow along. I think it would be the best thing possible.
Okay, let's stay in the theme of being clean, because you're very proud of your clean balance sheet. And Rob Jones asks, if you acquire new assets, will you use equity or debt, or a mix of both? Similar but also important question. You say you are debt averse. Do you rule out using debt in the future?
No, we don't rule out using debt. It's the easiest way to get in trouble in this industry, other than, poor rock selection. So I'm very cognizant, having been around for a while, that we will always be conservative here. But with the right asset profile, once production's online, you understand type curves well, we certainly would consider layering it in if we think it's in the interest of our equity shareholders. But up to this point, it certainly has not been appropriate for a company with a big appraisal project and very little production until now. That may change for us in the future. We'll use it when appropriate, but very conservatively.
Interesting. You say there that the only mistake you could possibly make is if it's poor rock selection. So how would you classify the current rock collections that you've got?
Well, I'd like my friend Gregor Maxwell, our head of subsurface, to come talk to you about that. We view the location as driving everything. And when we go into a basin like the Williston, it's great. You can look at thousands and thousands of wells in a general area and get a strong sense for what type curves will be and where production has been more impressive and where it's struggled. So we're highly selective from a location standpoint. It's one of the things that the more data we get on the paradox, the better we'll be there as well. We have the benefit of great seismic and the ability to choose our locations carefully there as well. So it's a key driver for us. It's something we'll always focus on.
Colin Harrington, Chief Executive of Zephyr Energy. Thank you. We've all enjoyed your inclusiveness, particularly your red carpet speech, that note of gratitude to your multiple partners. And I think after hearing that presentation, I can understand why you're so attracted to
that's not a red carpet speech. It's true gratitude. I was brand new on the AIM market, and we've had great advisors helping us and really sticking their necks out for us when we began this. So I'm particularly appreciative of them, and I want to say one more thanks.
You're more than welcome. Thank you, Colin. Thank you very much indeed.
Thanks, Sarah.
There you go.